Hey, it's Tim Dial again, Next Mortgage. Just wanted to get into the grant that I'm going to cover here. This is something that I always cover on my virtual webinars that I do. I do virtual webinars every month, and I always cover this lender grant. So I'm going to go over that. Now, just to give you some information up front on it, this grant doesn't work for everybody. As a matter of fact, I would say it works for a very small percentage of people. And I'm going to get into the reason why that is here in a few minutes. But typically, one of the other programs that I've covered will end up being a better fit for most people. And that is, for instance, the Hoper program, which I covered on a previous video. And then also there's a 5% down payment assistance program that I covered on a previous video. This video is the third in the series. I wanted to get into a lot of these down payment assistance programs and go over them and talk a little bit about what, who they're good for and what type of customer they're going to work for and things like that. So just kind of get into the specifics of it. So the way that the grant works is they basically give you a grant that is 3.5% of the purchase price, because that's the exact amount of the down payment FHA requires. So they're giving you a grant for the down payment, the entire down payment, and then you don't have to pay it back. And that's the key to it. That's why it's a grant, is because you don't have to pay it back. Now we used to have one of these that they would forgive on day one. So, it was like you didn't have to do anything special. It was forgiven on day one. Now they've changed, that program no longer exists, but the other grant program we still utilize, which is very similar. And for them, they don't forgive it for 6 months. And the reason they do that is because they want to make sure that somebody doesn't do something to refinance within that first 6 months. So, and you're not supposed to be able to refinance within 6 months or pay it off within 6 months, but you're not supposed to be able to refinance within 6 months anyway. FHA has rules against that. Their rule is that you have to wait at least 210 days and you have to make 6 payments. 6 payments is more like 8 months. So because you always skip a month before your first payment's due, etc. So it usually takes about 8 months to get past the 210 days and the 6 monthly payments that FHA requires. But they still put this rule in there that it's not forgiven for 6 months because they want to be absolutely sure, because there's this thing where if somebody were to refinance within 6 months, then they would actually lose money on it. The lender that does this would. So anyway, that's why they put that rule in place. And so that's how that works. Now, I'm gonna share a screen here and get into an example. I always like to go through examples. So this example I'm going to go through is actually directly from my slideshow that I do on my virtual webinars. And this is just one slide and a whole bunch of slides that I have for the virtual webinars. But I wanted to cover these grants on their own by themselves on YouTube so that people can access them whenever they want, etc. So that's what I'm doing here. But I'm going to go ahead and I'm going to share the screen here right now. So it should be coming up on your screen right now. This is an example that I go through during the virtual webinar. So assuming that the purchase price of this house is $400,000, the 3.5% down payment then would be $14,000. FHA does charge an upfront mortgage insurance of 1.75%, but you don't have to pay that at the closing. They just add it on to the loan amount. So after the down payment and then adding on the mortgage insurance, the loan amount ends up being $392,755. The down payment grant is $14,000. Closing, now here's the key to this, and this is why it doesn't work for most people. And that is because the grant has higher closing costs than any other type of down payment assistance. They have things in there that are points. If you're not familiar with what points are, 1 point equals 1% of the loan amount. And so if you've got like 2 or 3 points built in, that's an extra, that's an extra in this situation. That would be an extra like $6,000 or so that's built in as far as closing costs. And they also have a few fees in there for the grant as well that cause it to be a little bit higher. So In order for this to work for most people, we usually have to get the seller to cover like 5 or 6%. I put 4 to 6. It does depend on the price and things, but usually it's like 5 or 6% of the buyer's closing costs in most cases to make sure you're not coming out of pocket a good amount. Now, if you do have some assets, then it's more likely to work for you. But if you're really short on assets and you really can't afford to bring much to closing at all, then we really need to get the seller to cover like 5 or 6%. The issue we run into is when you make an offer to a seller, the seller has to be extremely motivated to sell before they're willing to give 5 or 6%. Sometimes you can get them to give 2 or 3%, but getting them to give 5 or 6% is super difficult. I do have a transaction right now that's a VA loan, and we have the seller giving $13,000 on that deal, which is quite a bit. So something like that, it could potentially work, but for most buyers, it's not going to work, because you go and you make an offer on a house, they're going to reject your offer, or they're going to counter the offer, and they're going to drop that closing cost that they're covering. And that happens most of the time. Now, not all the time. I have done these before, and they have worked, and we have closed them. So keep that in mind. If you find a motivated seller, then it can work. Now, the other part of that is sometimes the sellers want a higher price if they're covering more closing costs. And the only way that works is if the appraisal comes in high enough for that higher price to work, right? So, if let's say you start on a transaction, the seller's giving you 6% for closing costs, but he wanted an extra $5,000 on the price of the home or something like that, then if the appraisal comes in and it's 5,000 low, he would still have to come down to that purchase price, and then he may want to renegotiate how much closing costs he's covering. So keep that in mind as well. That's a little bit about how that works, but yeah, the key to this is the 14,000 here is completely forgiven after 6 months. Now, the other part of this too is these grant programs that the lenders have higher interest rates than whatever the normal going interest rate is. So, and it's usually like 1 to 1.5% higher. And so that's something that we also have to consider. That's why Hoper might be a better choice for some people. You get the solar panels and things like that installed, which I covered Hoper on a previous video. But you get the solar panels and things like that installed, but the interest rate's quite a bit lower for Hoper. So even though they're financing in the solar panels, you get a better interest rate. So the payment might be similar to this grant program. And then you have the solar panels, which increases the value of the home and also reduces your monthly cost because you aren't paying for energy, right? So that can be better for some people. And so that's how that works. And these grant programs, they want you to have at least like a 640 credit score. I didn't put that on here because they're changing that all the time. I believe it used to be 620, and I think that they've changed that to where they want 640 or better now. So anyway, that's a little bit about how that works. If your credit score isn't good enough, I am going to do another one of these where I cover some credit stuff, and because that's something that's very important to people. And I have people almost every month that I get closed that didn't have good enough credit the first time we spoke or the first time we pulled credit, and then I help them bring those scores up. It is much more efficient to do that than to send somebody to one of these credit repair companies. I believe these credit repair companies are kind of a scam because what they do is they charge you a monthly fee and they try to string it out for as many months as possible. Whereas a lot of times we can get people's credit scores up within 2 or 3 months. These credit repair companies will try to get people to be paying them for like a year if they can before their credit score comes up enough. So I think those things are a scam. Plus, you can use some of that money you would pay those credit repair companies. You can use that to maybe pay down some stuff on your credit, and it's a much better use of your funds. So anyway, that's a little bit about how all that works. Like I said, I will do a credit video probably in a couple of days and post that on YouTube as well. And if you haven't watched them yet, go back and watch my other two down payment assistance videos. One of them is for Hoper. The other one is for the 5% down payment assistance program, which I've used many times, and it's a great program for a lot of customers. So anyway, that's pretty much what I wanted to cover here. Please feel free to comment or anything like that. Subscribe if you would. We'd certainly appreciate it. And I look forward to talking to you later. Thanks. Bye.